You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music means it is time once again for Options Bootcamp. The cool kids are calling OBC, the show for you, the basic retail stock trader. Maybe you're looking to dip those toes in the options waters. Maybe you've tried a little bit. Maybe you got burned. Maybe you had a little bit of success. You want to build upon that. Either way, we got you covered here. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from this fine network upon which you're listening to this program. Hopefully, a lot of you I know are tuning into boot camp every week. Hopefully, you subscribe to the full network as well. If not, you're missing out on a bunch of content that's coming at you pretty much every day, sometimes twice a day. Just got off our advisor's option show. That's coming at you very soon. We, of course, have the option block here on the network, volatility views, this week in futures option, a whole bunch more. Options Playbook Radio. You guys, if you like this show, you're not listening to OPR, you're missing out. That one's perfect for you guys as well. So a lot of great content coming at you pretty much every day, multiple times a day often here on the network. So wherever you're listening to this, make sure you subscribe to the full network. And if you like what you hear, of course, leave a review so we can continue that explosion of new listeners discovering the program week after week. It makes Dan excited, and that's really the reason that we do this here. Speaking of Dan, of course, I'm talking about my cohort, my partner in crime here, the black-hatted one, Mr. Dan Passarelli, the founder of Market Taker Mentoring and the author of one or two options-oriented books out there. Mr. Passarelli, welcome back to the Options Bootcamp Drill Instructor Proving Ground, sir.
It is so great to be back, Mark. I can't even tell you.
Well, I can tell you. It is great to be back, and it is time for our basic training.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Pull in, print bear to learn.
All right, everybody, welcome to the basic training segment, the portion of the show where we break down some basic options concept, go into a little bit more detail on it. Today's topic is one that we touched on in the past before, but given your feedback and your questions, and just in general where we are in the market right now, it seemed like a good time to revisit this topic, Mr. P, and it was inspired by this listener question coming from Randy. Randy wanted to know, in the not-so-family-friendly version, why are puts so blanking expensive? That one just brought a smile to my face. We've all been there, Randy. We all feel your pain. Yes, particularly right now, they are so expensive right now. So, Mr. Dan, what do you have to say for Randy? Why are puts so blanking expensive, sir?
Because they're worth it, Mark.
Uh-oh, there goes our explicit tag now on the iTunes store, listeners. There you go. Dan blowing up the whole network here. Cover your children's ears, listeners, listening in the car while you're driving along. So they're worth it. Why are they so worth it, Mr. P, in your estimation?
Well, the thing is like, look, so imagine you have an IRA, you're like 60 years old or something, you have an IRA worth $1 million, you worked hard your whole life, and, all of a sudden a pandemic hits, and holy cow, 30 years of work, half of it's gone, So, they're extremely powerful risk management tools. Insurance policies basically is how I like to think of them. So, they're really, really valuable. Now, part of, maybe a better avenue to go down with an answer to this question is that high price tag affordable? I mean, justifiable, like owning a put? Yeah, you can justify owning a put, wanting to own a put. The value is there. But sometimes, can they be priced out of the market? Can they be so expensive that, that it becomes onerous,
Yes, well, certainly at the levels we're seeing right now, some could certainly term them as onerous. So let's get to that a little bit. Why are puts so blanking expensive? Epithets aside, there obviously is a lot of components to an options price. If you're not familiar with those, Randy, or any listeners, I encourage you, go back, check out our earlier episodes of this program, or of course OPR and others, or check out Dan's book, Trading Options Greeks, breaking down all the different components. Of course, the Greeks are the many variables that come from the Black-Scholes equation that help make up that options price. And one of them, of course, is Vega, which is the volatility component of an option. So as volatility is generally high, and that's in general where we are right now, certainly not as high as we were back in the madness of March into April when VIX cash was north of 80 and everything was seemingly on fire in the markets. We've certainly come off from that, but volatility is still fairly elevated out there right now. A lot of that having to do with the election coming down the corner. In fact, we were just debating this topic on our advisor's option program not too long ago about what is keeping volatility so elevated right now. And a lot of that is that concern, that fear around the election. And of course, do you buy into that? Maybe not. Maybe there's some trading opportunities around that. If you look at what the volatility surface, the VIX futures are pricing, they predict volatility going well beyond the election into even January. Maybe pricing in, we won't know who the president is until inauguration. That's certainly anyone who was on the floor like myself trading back in the Bush-Gore 2000 days doesn't want a repeat of that. So hopefully we won't see that. But volatility, of course, a big component of an options price, particularly when you're talking about puts. Now, you're mentioning puts. I'm assuming, since you're listening to this show, you're probably coming to us looking at equity or index options. That's probably where the lion's share of you are hanging your hats out there. So what happens in those products is something even more pronounced and kind of exactly what you're talking about here, Randy, which is, of course, investment skew. If you don't know what we mean by skew, again, check out our earlier episodes of this program. But volatility skew effectively shows you where the puts are lining up versus the at the money and the calls are lining up versus the at the money from a volatility perspective. And what's called investment skew is this phenomenon you have rightfully mentioned here, Randy, where effectively the puts are expensive, as you put it. The puts are usually in more demand in equity indices and in big equities like Apple than the calls are. Because think about it. Everyone's coming in, they're long SPY or they're long Apple or whatever the case the equity underlying is. Pick your poison out there. So what do you do if you're long an underlying? You probably want to buy puts to hedge it. So that's hence driving up the volatility premium on those puts, making them, therefore, more expensive. At the same time, maybe you're trying to finance those puts, or maybe you're just trying to generate a little bit of income. Either way, you're probably writing covered calls on that position as well. So you're depressing the volatility of the call wing at the same time. So that results in this twist to the skew, where the puts are very rich from a vol perspective, and the calls are substantially cheap. We pulled up some numbers here. You guys can do this yourselves, by the way. If you listen to our TWIFO program, you know what I'm talking about. If not, just head on over to the page we've created for that program. I'll let a little backdoor for you bootcamp listeners as well. CMEgroup.com/TWIFO, TWIFO, or /TWIO, TWIO, This Week in Futures Options, or This Week in Options. What we've created there is a great free report. You guys can generate these skew numbers for yourselves on big products like the S&P or any equity index you want, not the individual stocks, but the equity indices over there. And you'll see this exactly in stark relief once you do that. You'll see the graph. I'm looking at it right now for the S&P 500 E-mini, and the puts are demonstrably expensive out there right now compared to the at the money. In fact, I also ran the numbers just to check exactly how rich. That's another thing those TWIFO reports will do for you. They will break down the skew for you and show you exactly how rich the 25 delta put and the 25 delta call, which is the risk reversal people usually like to use to measure skew, how rich or how cheap they are to the at-the-money volatility right now. We broke it down here for you in September. The September at-the-money vol on the E-mini is pretty light, about a 16%. It's obviously not pricing in that election vol. And yet the puts are almost 30% more expensive right now. The calls are 16% below that level. The puts are 30% above that 16%. So you're talking north of 20, about 21% for a 25 delta put in September. Go out to December, a little bit farther out, past the election. Maybe cooler heads are prevailing out there. Well, the at-the-money vol in December right now in the E-mini is about 22.5%. So obviously still frothy as a result of the post-election kerfuffle, perhaps they're pricing in. And the puts are 30% more expensive than that, 30.3% to be exact. So you're talking a put vol, that 25 delta put, nearly 30% you're paying from a vol perspective out there. And that's, again, a reflection of everything we were just talking about. The indices are at all-time highs or threatening them pretty much every time. So people who are long it are a little bit nervous. People who are getting into it right now are also a little bit nervous. So they want to buy some puts to help finance that, which is contributing to this crazy skew. Of course, we have this big event. Our friend Matt from ORATS on the last show was just talking about how you can view this election as a bit of an earnings event for SPY. And that certainly is true. If you view it from that perspective, you're seeing a lot of this vol baked in there. And it's pricing in right now around a 3% move they're expecting for the earnings event, which actually sounds light given all this vol we're pricing in out there. So a lot to unpack. Dan, any thoughts you have to add here for these skew levels in the S&P or in general how the vol skew and the investment skew for equities and indices helps to contribute to the expensive puts, as he calls it?
The thing is there exists this sort of natural supply and demand pressure on different strikes in the options, all in the options vertical within any particular expiration. And, if people are buying options, they're more apt to be buying puts. And if people are selling options, they're more apt to be selling calls. So, you always have this skew baked in there somewhat. And I suspect that it's getting it's getting a bit steeper, as they say, like what we would call the downslope, which is the put skew is a bit steeper. And, that's because I think there's a lot more fear. We're at as of today that we're recording this, we're at all-time highs in the market. And the last Fed announcement, the Fed said that they expect the economy to suffer 6% this year. So there's a very there's some cognitive dissonance going on with that. I think, right? Like, how is the market higher than it was when the Fed says we expect the economy to be lower than it is? So when you're at these levels, especially when you're from an investor standpoint, when you're sitting on a really big profit anyway, geez, why not throw some money into some puts? I'm personally doing that in my IRA right now.
I think you described this entire year as cognitive dissonance, Dan. It's really just an insane year from just about any perspective. And it translates in a lot of different ways, including to a healthy premium for those puts. That said, if you want to go beyond your traditional equities and equity indices, you can find some products that don't have very expensive puts right now. Again, if you get out to the commodities, the skew is a very different ballgame, and it depends on what's going on in that underlying product. For example, I pulled up that same report I used to generate the reports on the E-mini. I also used it to generate a skew report for gold. And gold's in a little bit of a different scenario. The puts are bid right now because gold, as you know, listeners, is threatening at all-time high. But also, the calls are super bid right now. So you have actually a smile. You have that smile shape where both of them are pretty much at about an equal volatility level away from the at-the-money out there. So no matter what you're doing out in gold, buying puts, buying calls, it's going to be a hefty premium out there. Other products where a lot of the concern or interest is to the upside, not so much on the downside, the puts could be pretty cheap. So I encourage you to use that scanning tool to go out there, and if you're comfortable trading futures options, then that might be a place you can go look where the puts are a wee bit cheaper. But in general, that's a long answer to your question there, Randy, as to why our puts are so expensive. But effectively, it's the volatility component of these products, and that volatility is getting pretty lofty, not so much in the at-the-money right now, even though that is firm, but definitely in the put wings. We're seeing the puts on these major indices 30+% rich to the at-the-money vol, showing just incredible demand. At the end of the day, it's all basic supply and demand. If people want puts, they're going to be expensive. If they don't want them, they're going to be cheap. And right now, people want them. So they're expensive. We've talked before many ways in the past on this show. Go check out the archives, ways to pay for puts. There's a lot of ways you can do it. Of course, the collar is a standard way. Buy the put, sell the call, hold it against the underlying position. Now, that call is going to be cheaper from a vol perspective, so it's not going to pay for all of that put. So you can play with other things, maybe a collar with the kicker. You sell a covered call against the put. Also sell a farther out of the money put against that put. So taking advantage of some of that hefty put skew we're seeing out there, and also, of course, limiting your downside protection now, but also limiting dramatically the outlay for that put. There's a lot of ways you can go. You can turn that put spread into a ratio if you want to get long to the downside. There's a lot of different ways you can go with this, listeners. Again, encourage you to check out our archives to do a deep dive into that, or hit up Dan and his team over there. But I wanted to touch on this right now because it does seem like a very of-the-moment question and an of-the-moment topic. But now we have a lot of you guys hitting us up. We have to get to some of your mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody. Welcome to your segment, of course, the mail call, the portion of the show where you guys take the reins, your questions, your comments, your insightful nuggets to share with us and with your fellow listeners. I'd like to kick this segment off with a little bit of love. It's a very tumultuous time out there, very hair-pulling time. You got people like Dan swearing up a storm here on the show. So let's kick it off with a little bit of love. This bit of love today comes from Tony P. Tony P says, a short note to thank you for an amazing network with excellent educational content. I have been listening to your programs and parsing the knowledge for several months and love to listen on my way to work and back. Thanks to you and your guests for their time and knowledge. Dan, cover your ears. Dan and Uncle Mike are standouts. You'll make his head even bigger there. Tony P, thanks a lot. Wishing you the best, and I'm sure I'll be writing with myriad options questions in the future. Sincerely, Tony P. Well, thank you for that question. My joke aside, and even though you like Dan, I can't hold your taste against you. Mr. P, what do you think? A little bit of love specifically for you here to kick off the show, sir.
Well, that is awfully kind, Tony P. Thank you very much. I appreciate that. And you know, I'll tell you what, like Mark and I mean, I can just speak for, I can just speak for Mark, not really myself. But, like we love doing this stuff, man. Like we love just being able to help out and provide value any way we can. And, boy, it sure is nice hearing some positive feedback like that.
Let's see if we can keep the positivity train going here. Let's go on. Michael Smith. Michael Smith says, you often talk about the largest volume contracts. Is there a way we can normalize this data? So trading 10 contracts of Tesla, not the same as 10 contracts of Ford. What's the best way to look at the notional on this? Oh, he added an addendum. He says, as I continue listening to the Options Bootcamp episode from today, or as the cool kids put it, OBC, Mr. Longo, you should read this one. He sends a link to Cabot Cheese. I believe, Dan, this is in reference to our last show where we were talking about the person who sent in the picture of their burgers. A lot of food-related commentary on the show for some reason. I guess we're hungry when we do this show. He sent in the picture of his burgers, and they were mostly cheeseburgers. They were dripping with cheese. And I said, well, that's not good for me. I'm lactose intolerant. So he sent a link to the Cabot Cheese website and says their products are naturally dairy-free. Well, thank you for that, Michael. I have checked out Cabot. I have seen their descriptions of themselves as naturally lactose-free. They haven't, for some reason, really lived up to that reputation for me. But maybe I have to try all of them. Maybe your mileage may vary out there with those. So I have tried those. I thank you for the recommendation, but they haven't worked as well for me. Dan, let's go back to his actual question. He's asking about normalizing volume, looking at between Tesla and names like Ford. Tesla, obviously $2,000 right now, and Ford around $6 or $7, I believe, right now. He wants to know, because he wants to see how the stock split affects Apple and Tesla trading volumes. He wants to know if there's a way to track that. When you're talking about volume and things with your clients, do you do any normalization between cheaper names like Ford, sir, and shall we say very rich names like Tesla?
Yeah, I mean, like with any option trading, you have to. I mean, there's a couple different ways to do it. With any option trading, it's very, very simple just to say, hey, look, this is a trade where I'd be really good investing $1,000 in it, right? And so that could be one call at $10 or 10 calls at $1, So like that's just a real simple eyeballing it, hand-to-hand combat, just like really, easy way to look at it. But, there's some strategies where it benefits you to look at what we call the dollar deltas. And so basically what that is like, let's say you're looking at a call in Ford Motor Company. Let's say it's trading at, I haven't looked at that stock in a while. I used to make markets in that on the options in Ford. But let's say it's trading at $9 and you buy one of the at-the-money calls with a 50 delta. Well, deltas are effectively like shares, right? And so if you own one 50 delta call, it's the exposure of owning 50 shares. So 50 shares of a $9 stock is $450 worth of stock. So that's a dollar delta. And then, whatever other company, if it's a, $90 stock and you own one of the 50 delta 90 strike calls, well, 50 deltas is like 50 shares times $90 is $4,500 deltas. It's just kind of the same thing. Like if you're looking in your investment account, you say, oh, I've got 100 shares of this stock at this price. So that means I own this much of that stock, So that depending on the strategy and what you're trying to accomplish, that can be a really, really smart, useful way to look at it.
Well said there, sir. I'm trying to think for Michael here, because he's obviously talking about some of the reports we put out on our site. And one of the reasons we don't talk about notional, Michael, is just because parsing things, notional value of the volume, really, things like SPX tend to dominate the tapes. You have to filter that out because that's a huge, very beefy product out there. So it makes it hard to kind of find that data. I'm trying to think of a way for you guys, listeners, to make it a little bit easier for you guys to access this data. The folks at OCC, they may put out the numbers in terms of notional if you want to see it that way, because you're right, 1,000 calls on a $6 and change Ford is different than 1,000 calls on a $2,000 Tesla. The notional value difference is enormous there. So the folks at OCC may put out a notional report. We also generate a lot of our reports from our friends over there at Trade Alert, which is now part of the SIBO empire over there. I'll have to check and see if they put out something on the notional side that maybe we can relay to you guys, make it a little bit easier. But I think, Dan, in the meantime, well, first off, check with your broker, see if they have some tools that might make it easier for you to parse that. But in general, I think Dan's notion of the dollar deltas is a good way to kind of do an end run around this. But that's interesting topic. I know in our crypto show, it drives me crazy because so much of the crypto options volume is reported in notional. I don't find that very meaningful. So that show actually in that marketplace has the opposite problem. Everything's in notional. It's kind of hard to find exactly what's trading out there because all you see is notional, and that could be just a bunch of really deep calls for, not much use. So notional, not the most useful, but maybe for comparing and contrasting it can be. So I'll look into seeing maybe we can find a report that could be a little bit more insightful for you guys on the notional value comparison. But in the meantime, definitely check out your broker and check out OCC, Options Clearing Corp, because they put out a lot of numbers over there. And I know they parse it by contract volume. They may parse it by notional as well, which could be a way to do an end run around this for yourself completely for free there, Michael. All right, next up, Sean. It's a great name, Sean Nunnery. I like that. Sean Nunnery wants to know, I know you guys record the show from Chicago. Why is Chicago considered the home of the derivatives market? Aren't these things traded in other major market centers like New York City and London? Love the show. Looking forward to reading Dan's books. Well, Dan, you're getting a lot of free love here on the show. I'm going to start charging you to come on just to get all this love you're getting here on the show today. First off, let me correct a thing. I record the show from Chicago. We're here in the heart of downtown Chicago. Dan's way out there in the hinterland somewhere, so he doesn't really technically count as Chicago. So let's just lump him in the extra, the also-ran, the suburbs of Chicago. But back to the core of your question. Why is Chicago the Mecca? Well, quite frankly, it's because these things were created here and brought to life. The options most recently, that was Chicago Board Options Exchange back in 1973, which someone just pointed out on my show recently today is almost 50 years. That's terrifying to think of because I was just at the 40th anniversary of the SIBO. It doesn't seem like it was that long ago. We have an image hanging in the studio from that as we speak. So that's closing in on 10 years ago now. My, how time flies during a pandemic. But the Chicago Board Options Exchange was really the birth of the modern options industry as we know. That was a spinoff of the Chicago Board of Trade, which had existed for a better part of a century before that out there. So the Chicago Board of Trade and, of course, the Chicago Mercantile Exchange, which kind of now owns the Board of Trade and is the largest derivatives exchange on the planet right now. So those three entities, the Chicago Mercantile Exchange, the Chicago Board of Trade, and the latter portion there, the Chicago Board Options Exchange, they really created the modern derivatives industry as we know it. So yes, these things are traded. You know, there was NYMEX, now part of CME Group as well. It had heating oil and things like that. London, they trade other things. Other countries have derivatives markets, certainly, but nothing to the extent of the U.S., and certainly from a city perspective, nothing to really rival Chicago. Dan, anything to add? And also, do you want to either confirm or deny that you are not in the heart of downtown Chicago, sir?
I'm close enough. I am in the suburbs currently. That's where MTM World Headquarters is, which is also my house. Hello, pandemic. But I do have two things to add to that. One is also, let's not forget that the Black-Scholes model was birthed in Chicago, incidentally the same year in 1973. And I wanted to throw in a little trivia question. Maybe I can stump Mark.
Impossible. Impossible, sir.
So it is true that the CBOE was spun out of the Chicago Board of Trade, which, you know, of course, is why it has kind of the funny name that people from outside the industry mess up all the time, Chicago Board Options Exchange. But the CME Group was spun off another exchange. What exchange, Mark, was the Chicago Mercantile Exchange birthed out of?
I believe that was the old butter and egg exchange, correct?
Oh, yeah, good job.
You can't throw a curveball at me on my own network, sir. Who do you think you're talking to?
Good job, man. Good job.
Now, if you ask me the year, I may stumble on that one, but I got the entity down out there. But yeah, that's a good point about the Black-Scholes. It's kind of hard to have the CBOE without the Black-Scholes. They kind of go hand in hand, even though the options market has evolved beyond that. Now there are many pricing models, but it all kicked off around Black-Scholes, and we still talk about all the derivations there, the Delta, Gamma, Theta, Vega, all the fun stuff that Dan has written legions of books about. All right, we're coming up against this. So let's end on some fun here as well. I remember on our last show, we had a question from a listener. His name was Baiju, and you wondered out loud, and I believe even on Twitter, as to what the origins of his name were, and was he somehow linked to a Chinese liqueur that I don't believe you had a fond view of. Well, Baiju heard that, and he responded. He says, "Hi, Mark. Thanks to you and to Dan for answering my questions last time. And no, my name was not inspired from the Chinese drink. However, imagine if your parents named you after their favorite booze. Did they just run out of options at the pubs?" You could tell he's over there in London talking about the pubs. So there you go, Dan. Answer to your hard-hitting questions there. He was not named after your favorite Chinese liqueur.
I am not named Martini or Old Style.
Yeah, I think Old Style is probably more appropriate for you there. So thank you for clearing that up there, Baiju. All right. Unfortunately, that music means we've come to the end of this weekly sojourn through the world of options boot camping. But of course, if you like what you hear here, check out the rest of our network. OPR coming at you in a little bit. Won't be live, but it'll be live to tape on the network, so you can hear Brian breaking down some great strategies, some analysis, answer some of your questions over there as well. So if you're listening to Options Bootcamp, definitely check out OPR. It's pretty much the sister show to this program. And of course, throughout the rest of the week, we got tomorrow, big day, Options Bootcamp, or I should say Option Block, coming up tomorrow, as well as TWIFO this week in futures options, breaking down the futures options side of the fence. If you want to hear more data, like those reports I mentioned at the top of the show, we go into that stuff in a lot more detail on TWIFO. And then back again on Friday, volatility views coming up at you there in the middle of the day. And we kick it all off again on Monday with Option Block, heading on into Education Wednesday, which is, of course, Options Bootcamp Day. But Dan, before we go, if folks are intrigued, maybe they want to debate Chinese liqueurs with you, or maybe they just want to talk options, where should they go? What should they do?
Yeah, I welcome connections. That'd be great. Surf on over to markettaker.com, and you can hit the Contact Us page. And I get emails from listeners every now and then, and I love when that happens. So, yeah, don't be a stranger, guys.
hit Dan up. He wants to talk about more than just Chinese liqueurs, or maybe you want to talk about the Black-Scholes model or anything else. Hit him up. Market Taker Mentoring is the place to go. 2 T's. Don't forget the 2 T's over there. Give him a follow on the old Twitters. He's Dan_Passarelli. 2 S's and 2 L's at the end. He's like double consonant guy over here. Dan_Passarelli. On behalf of the Black-Hatted One and indeed myself, I want to thank all of you out there for downloading, streaming, subscribing, for sending in so many great, many, and varied questions. Keep them coming, and we'll see you next time for more Options Bootcamp.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.